Is the world going back to the 1970s? Stagflation. Is it going to happen right now? That's what The Economist asked in a recent article. I'm going to read parts of it to Jeff to get his reaction live and see what he thinks. Maybe he agrees or disagrees with what The Economist writes. Let's find out. By the way, this was written on the 5th of October, 2021, and the title was, Is the World Going Back? Is the World Economy Going Back to the 1970s? And Jeff is the head of global research for Alhambra Partners. Jeff, here's how it starts out. Oh, by the way, here's how it starts out. Stagflation of the 1970s is back on economists' minds today as they confront strengthening inflation and disappointing economic activity. The voices warning of unsettling echoes of the past are influential ones, Jeff Snider, including Larry Summers and Kenneth Rogoff and Rogoff and El Erian. Stagflation is a particularly thorny problem because it combines two ills. Sorry. No, we continue.
You bring up those three guys, and as I keep saying, they've said this stuff before, right? And they're half right? The one part they get wrong is the inflation part. It's not the stagflation. Stagflation is supposed to mean weak economic growth with inflation. That's not really what happened in the 1970s. You had rapid nominal growth, but no real growth because the prices were through the roof. We don't have that problem today because there is no economic growth. And if there is no economic growth, because there's no money in the system, or at least not sufficient levels of money in the system, how the hell are you going to get inflation? And that's the reason why, in particular, Rogoff and El Erian, but also Larry Summers and Kenneth Rogoff, they were wrong 10 years ago when they made these same claims. That's why I keep saying why doesn't the Economist or anybody in the media hold these people to, if you got it wrong last time, why are you correct this time? You can't even explain why it was wrong 10 years ago or just 3 years ago for some of these people. Why are we listening to you now about inflation when you can't seem to understand or get what's going on in terms of inflation? You don't seem to get inflation at all.
Now, one of the points that people will put in the comments section, I'm struggling today, ladies and gentlemen. I don't know why, but you'll just have to bear with me. What do I want to say? I want to say that people are going to complain that you don't know what inflation is because you're a hedge fund manager living in Greenwich. Yeah. That's what they're going to say. But you always explain in many of the shows that we do that there's such a thing as inflation caused by central banks or private banks creating a lot of money in the system, monetary inflation. And then there's price increases due to demand surges and supply shocks. And you believe it being the latter that we're witnessing and not the former. Price increases, yes. Inflation, different, no.
Yeah, monetary inflation. I hate using that term because all inflation is monetary. But okay, let's make that distinction. Monetary inflation, it will continue. Any kind of other type of price, price bulge, price deviation, whatever you want to call it, it's not inflation. They're going to, once it happens, the economy will adjust to it and prices will normalize to where they were before. It won't continue because it's not being fed by a monetary system. And so when I say it's not inflation, what I'm saying is there's no monetary component to make sure that the price increases continue month after month, and not just month after month, but year after year. That's what inflation is. It's not just a couple of months where the CPI goes through the roof, because we've seen that before, including in the last 12, 15 years, most prominently during the middle of 2008, which nobody would confuse with inflation. We have these temporary price deviations that happen from time to time because we don't live in a perfect world. And there are often frictions and considerations, imbalances that create the conditions for consumer prices to do all sorts of things, but only on a temporary basis if there's no monetary background behind it. So what I'm saying is, yes, you could see the price of food at the grocery store skyrocket, but that doesn't necessarily mean that the monetary system is to blame. And that therefore, if the monetary system is not to blame, you're not going to see a wide scale increase of consumer prices continue on for a very long period of time. You might be paying higher prices for meat and beef, but that might have, or more likely, the cause of that, the increase in beef prices has nothing to do with the Federal Reserve, which it doesn't. More likely to do with supply and demand, or supply factors in the production of beef itself, not some macro factor that applies to the entire global economy.
Back to the article. Stagflation is particularly a thorny problem because it combines two ills, as we talked, high inflation and weak growth, that do not normally go together. So far this year, economic growth across much of the world has been robust, and unemployment rates, though generally still above pre-pandemic levels, have fallen. But the recovery seems to be losing momentum, fueling fears of stagnation. Inflation has risen above central bank targets across most of the world and exceeds 3% in Britain and the euro area and 5% in America. What worries stagflationists is less the precise figures than the fact that an array of forces threatens to keep inflation high even as growth slows, and that these look eerily similar to the factors behind stagflation of the 1970s. Now
And
they'll give
that's really a problem already because these people have no idea what really happened in the 1970s. As I've said before, the great inflation story needs to be completely rewritten because it wasn't the Vietnam War and the Fed's even keel policy, as Alan Meltzer has alleged. There was something else that went on during the 1970s that during the 1970s, a lot of researchers and scholars and economists actually took interest in. But since the 1970s, nobody has paid any attention to, which is the whole reason why you and I, Emil, are on this podcast right now, because the mainstream of economics has decided that monetary economics wasn't worth its time or effort since the 70s, largely because nobody really understood the monetary evolution, really the banking evolution of the 1960s and 70s enough to put together a real story behind stagflation, certainly the inflationary component in the 1970s, which wasn't what most mainstream conventional analysis was. Otherwise, we wouldn't have gone into this opposite since 2008, which is that same system now and suddenly in reverse, which is now we're in this deflationary rut that nobody can explain because even after 2008, mainstream economics still has very little interest in monetary economics.
The Economist now gives three arguments that the stagflationists offer. And here's the first one. One parallel is that the world economy is once again weathering energy and food price shocks. Global food prices have risen by roughly a third over the past year. Gas and coal prices have hit record levels in Asia and Europe. Stocks of both fuels are disconcertingly low, and in big economies such as China and India, which is where they're low, power cuts, already a problem in China, may spread. Rising energy costs will exert more upward pressure on inflation and further darken the economic mood worldwide. That's argument number one. Argument number two. Stagflationists see another similarity with the past in the current economic policy environment. They fret that macroeconomic thinking has regressed. All right, that sounds right. Creating an opening for sustained inflation. In the 1960s and 1970s, governments and central banks tolerated rising inflation as they prioritized low unemployment over stable prices. But the bruising experience of stagflation helped shift intellectual thinking, producing a generation of central bankers determined to keep inflation in check. Then, after the
before you go on, that's one of the common mainstream explanations for the great inflation was the exploitable Phillips curve. Samuelson and Solow, who said if we tolerate a little bit higher inflation, we can intentionally trade off a little bit higher inflation for lower unemployment. And that was sort of what they're saying here, which was that the policy regime, the mainstream economics or orthodox economics at the time said will allow inflation, and that let inflation build up and get out of control because policymakers weren't on the ball. And what we're saying is that it wouldn't have mattered if policymakers were on the ball in terms of exploitable Phillips curve or not, because they didn't understand the monetary system itself. So even if they realized they should be constraining inflation, they wouldn't have known how. And that's kind of where we are again today. What we're seeing with, they're exactly right. It would a generation after the great inflation, what was everybody's biggest fear if you were in central banking or mainstream economics? It was inflation. And the same thing as in the 1940s and 50s, what was everybody's biggest fear if you were in central banking or economics? Deflation. What happens every time is economics reacts to the big problems that arise in each economy. The Great Depression caught everyone off guard because they didn't know what the hell was going on in the monetary system then either. And so after the Great Depression, for an entire generation, economists were strictly focused on deflation because that was the big problem in their immediate memory. Then you had the great inflation for very different reasons, Again, monetary misunderstanding. And that created the same type of impression on another generation of economists and central bankers who focused exclusively on inflation and got the public to focus their fear exclusively on inflation. And then what happened? We had a deflationary problem in 2008 that caught them completely off guard. And even today, they still don't understand that's what's going on, that some of these old school economic outfits, like the economists that are very deeply, very establishment, they're still in the 1990 mindset that we have to be worried about the 70s rather than having caught up to the reality of 2008 and forward, which has nothing to do with inflation whatsoever. In fact, this explains why up until this point, CPIs and inflation indexes around the world have failed time and time again, year after year, to agree with central bank targets. So there is definitely a policy problem here, but it's not the same one at all. In fact, what we're going to see is that over time, and this has already happened in a lot of places, that more mainstream scholarship is going to ditch this inflation fear, especially once these transitory factors fade and we get into next year and beyond, where these recoveries that don't recover are going to start to really appear and materialize over the last part of this year and into next year. And we're going to put this temporary inflation shock behind us. And we're going to go back to realizing that their biggest problem is deflation, not inflation, which is consistent with the pattern. We react to what actually happens, not what happened a long time ago.
The Economist continues a little bit saying that with this part two concern, that we're now more concerned about unemployment and we've taken our eye off inflation. So that's what stagflationists are worried about.
And that's exactly what we're saying here, because unemployment, people don't understand this. Unemployment is related to deflation. As John Maynard Keynes said in the 1920s, deflation is by far the greatest monetary evil, much worse than inflation, because deflation undercuts the labor market. And so those two things go hand in hand. If you see, not just high levels of unemployment, but persistently high levels of unemployment, lack of employment growth, that's really a deflationary symptom.
Part three, low interest rates weakened government's fiscal discipline and enabled vast amounts of stimulus during 2020. Now, as in the 1970s, worriers warn that governments and central banks may be tempted to solve supply problems by running the economy even hotter, yielding high inflation and disappointing growth. So those are
that part is true, but it's true for the opposite reason, right? Why have governments been able to get away with fiscal undiscipline? It's because this deflationary environment has preferenced government safe liquid assets, which just happen to be government debt. And so governments are riding the coattails of deflation. It's not the Fed that has kept low interest rates or kept interest rates low. It is the deflationary background, the lack of economic growth that has kept interest rates low. The interest rate fallacy, low bond yields signal tight money in the real economy, which governments around the world have taken advantage of to try to borrow their way. What they're saying doesn't just apply to 2021. It has applied to every year since 2009. Government budgets have exploded over the last decade plus to no avail. It doesn't lead to inflation because the reason they're allowed this fiscal indiscipline is because of the deflationary environment that preferences safe liquid instruments, including sovereign debt. So, yeah, we can expect that governments are going to spend a lot more, but that's not going to be a problem of too many treasuries.
Now, here's the twist, Jeff. The Economist doesn't agree with the stagflationists. Despite some eerie echoes, the past is not the best guide to the present. So let's see, though, if you agree with the reasons they give why we're not going to experience stagflation. These parallels aside, however, the 1970s provide little guidance for those seeking to understand current troubles. To see this, consider the areas where the historical comparison does not hold. Energy and food price shocks worry economists because they could become baked into wage bargains and inflation expectations, causing spiraling price rises. Yet the institutions that could underpin a new, long-lived era of labor strength remain weak for the most part. In the 1970s, about 38% of workers across the OECD, Organization of Economic, Cooperation and Development, were covered by union wage bargains. By 2019, that figure had declined to 16%, the lowest on record. Here's another argument in a similar vein. Cost of living adjustments which automatically translate increases in inflation into higher pay, were a common feature of wage contracts in the 1970s. But that practice has declined dramatically since. In 1976, more than 60% of American union workers were covered by collective bargaining contracts with COLA provisions. By 1995, that share was down to 22%.
It's
So that's
some of this is just non sequitur anyway, because back then, again, if you go back to the 1970s, as the great inflation was happening, economists trying to understand why it was, they blamed the labor market. They blamed unions for a lot of, again, wage increases. In fact, that's why when President Nixon closed the gold window, the gold window didn't matter to Nixon. It was the other economic programs that he announced at the same time in August of 1971, which were more prominently wage and price controls, because he had been told by macroeconomists at the time that wages were the issue behind the great inflation. If you stop the wage, if you nip the wage spiral in the bud, that will end the great inflation. So for a year, the government actually had to approve whether or not you got a raise through their wage boards throughout the economy. And guess what? It didn't make a damn bit of difference, because it wasn't wages that contributed to inflation of the 1970s. It's not wages. It's not the labor market. Inflation is a monetary phenomenon. And if you don't get a handle on the monetary situation, you're not going to get a handle on inflation or deflation. So looking and saying, oh, are workers going to be able to bargain higher wages and that going to be baked into higher inflation expectations? You're chasing the wrong rabbit. It's not what goes on in an inflationary environment. So even though the Economist is disagreeing with this particular stagflationary argument, it's a non sequitur. We're wasting our time here.
This one might also be non sequitur. By the way, you won't believe it, but I actually wrote non sequitur in my notes here. Okay, here we go. Moreover, stagnation in the 1970s was exacerbated by a sharp decline in productivity growth across rich economies. In the decades after the Second World War, government's commitment to maintaining demand was accommodated by rocketing growth in productive capacity. But by the early 1970s, the long productivity boom had run out of steam. The habit of stoking demand failed to help expand productive potential and pushed up prices instead. What followed was a long period of disappointing productivity growth. And now here's the part.
Which is, you know this as well as I do. That's a symptom of too loose money, where money just chases the most insane, ridiculous projects, nominal projects, because money chases too few goods, as well as money chases too stupid products or too stupid opportunities, because there's an overabundance of money. It's usually what characterizes this type of situation. So it's not governments that are investing in the wrong industries. It's that there was so much money that it started to get into more and more inefficient uses, which by definition, inefficient uses reduce productivity. That's a symptom, not a cause. So yes, non sequitur once again.
Here's the part that just gets me. Here's what they say, but bringing it to present day, we don't have to worry about it, because since the worst of the pandemic, however, it has strengthened productivity. Output per hour worked in America grew at 2% over the year to June, roughly double the average rate of the 2010s. Booming capital expenditure could well mean such gains are sustained. Jeff, this is...
that's kind of whistling past the graveyard too, right? Because look, 2% productivity is better than the 2010s, but the 2010s were some of the lowest sustained levels of productivity in modern economic history. So doubling the worst level isn't as good as maybe it sounds like it should be. But either way, that level of capital investment was essentially the least worst option that industry took, and even service economy took, because they didn't want to hire back workers.
Isn't the productivity looking good because there's so many people out of the labor force? So
absolutely.
This is how it's kind of positive.
You look at productivity in 2009, for example. Productivity in specifically 2009 was terrific,
right?
Because so many millions of workers were laid off, and a lot of workers who were normally complacent about their jobs really, suddenly they started to be the most model employee there was. This happens every time there's a recession. Expecting that to continue because of some sort of capital investment boom, when it really hasn't been a capital investment boom, it's just been a little bit more capital spent than had been normal for one of the worst periods in productivity in modern economic history. We're kind of extrapolating a tiny little something into this major possible factor, which is why you wrote non sequitur, because it's just a temporary thing, and that economists, especially macroeconomists, love to extrapolate in straight lines.
It's and it's not a tiny little thing. It's the great suffering of many, many people who are unemployed, and they're saying, "Oh, great, productivity is up." Why? Because we got rid of everyone, and look at all that suffering. Don't worry about it. Productivity is up, and we're gonna lock it in.
Yeah,
I
and
don't know.
normally
Get out
during
of
that,
here.
in a actual recession, which we haven't seen since the dot-com recession, a normal recession, you get that boost of productivity, which usually signals to businesses to start rehiring their workers again, because that means, yes, I have greater profit potential in my workforce. Plus, I'm seeing a recovery in demand. Therefore, I can afford to bring more labor back onto the payroll because we're going back into a normal economic period. But starting in 2008 and 2009, it was a very different response by businesses for very, very easy to understand reasons. Number one was the level of contraction was much sharper and much deeper than it had been because of the deflationary money behind it. Number two, massive increase in productivity didn't lead businesses to start hiring workers back. In fact, the deflationary environment they found themselves in, it actually strengthened their desire to not bring workers back, because they thought, I don't want to get myself involved in the cost of hiring new workers. I certainly don't want to pay them the wage that they want, because I'm not sure about the demand environment. I'm not sure about the liquidity environment. Am I going to be able to tap commercial paper for working capital needs? Because I sure wasn't in 2008, 2009. It's a very different situation where productivity in that short period of time, as well as some capital investment, we're actually reinforcing the negative deflationary pressures. And as you said, Emil, it's not a small thing. It's a small thing, the rebound, but it's not a small thing because it's the labor market that always suffers the greatest during these periods. And as long as that's the case, it's not an inflationary environment. Therefore, it's not going to be a stagflationary environment. It's still simply the same lackluster global economic growth environment that isn't actually economic growth.
The third
We
reason
have the stag without deflation, right?
the third reason that the Economist gives why there won't be stagflation is specifically for you. They even say, this is for Jeff Snider. Quote, another important break with the 1970s is that central banks have neither forgotten how to rein in inflation nor lost their commitment to price stability. In the 1970s, even some central bankers doubted their power to curb wage and price increases. Arthur Burns, then the chairman of the Fed, reckoned that, quote, monetary policy could do very little to arrest an inflation that rested so heavily on wage cost pressures. But
because Arthur Burns was wrong. I mean, that's history has judged Arthur Burns had the entire great inflation wrong. And the reason he had it wrong was the same reason Ben Bernanke got his tenure completely wrong, because neither of those central bank chiefs understood the monetary situation that they were trying to work in. So in that sense, Arthur Burns was 100% correct. There was nothing that monetary policy during the 1970s could have done to arrest the great inflation. And as we're going, I presume we're about to get into what was Paul Volcker's role in the great inflation versus what was his presumed role in ending the great inflation.
exactly. But the end of the era of high inflation, Paul Volcker, demonstrated that central banks could rein in such inflation, and this knowledge has not been lost. Ergo, there's not going to
There's
be
the
any inflation this time around because central bankers are competent.
all they need to do is follow the model of Paul Volcker, and that's all it is. That's all it takes. And nobody ever stops and thinks, well, what is that model? What is this Volcker situation? What is the Volcker policy to begin with? And when you actually take a look at it, it's not at all what you're told it is, which is essentially that central banks get whatever they want. Don't you dare fight the Fed. Because Paul Volcker, starting in 1980, he provoked not one, but two recessions, two really big recessions, to strangle prices in the crib and make sure that the great inflation was no longer going to continue afterwards. And ever since he demonstrated the Fed's massive power in the early 1980s, no one will fight the Fed. The Fed is the biggest inflation fighter ever conceived by human beings. And therefore, just go along with monetary policy. And economists have come to assume that everybody just does go along with monetary policy because all they have to do is whisper the word Volcker in everybody's ear, and the markets just react in the way monetary economic theory is supposed to. That's not at all what happened in the 1980s. I've got the receipts too. There's any number of transcripts that tell you these guys had no clue what they were doing in early 1980. And that includes Paul Volcker. He was as befuddled and mystified as everybody else was. They essentially said, well, we can't target reserves anymore because reserves are only the one thing that we control. The monetary environment is completely out of our hands and out of control. So what are we going to do? What they did was they started to target monetary aggregates because Humphrey Hawkins, the unemployment Act of 1978 or 77, required them to. And everybody believes that them targeting monetary components and monetary aggregates, which they couldn't control, was this act of provoking recessions. And oh, by the way, as these recessions happened in 1980 and 1981, 82, the Fed had no idea that they were happening. They weren't provoking anything. They were completely baffled and mystified. These recessions happened anyway. So they had no idea what's going on in the monetary environment. They had no idea what's going on in the real economy at the time. And after the 82 recession finished, they were not at all sure that the great inflation itself was finished either. They were just winging it as they went along, realizing that they were just along for the ride because it was the Eurodollar system that was in charge of everything. And this expectations policy, that this Volcker myth, was essentially invented afterward to try to explain the end of the great inflation in a way that made the central bank seem like it was the technocratic ideal, that there was no reason to even fight against monetary policy, even though it has no money in it, because Volcker will provoke another recession if he has to. And that was sort of the implicit threat that was unbacked by history. That was the implicit threat that created this myth of the central bank as the effective inflation fighter, that Greenspan then took another step and said, not only are we an effective inflation fighter because of Volcker, we know how to control the economy in either direction. We can slow it down as we want to, and we can speed it up as we want to, because the Federal Reserve, praise Volcker, is this technocratic ideal. And that was never the case at all.
We have got to do a full 1 hour plus episode on this, Jeff. But because we're already well over an hour, that's a good Cliff Notes version. We'll have to stop it there. Do you want to do a full, in-depth review of the Volcker myth in the future?
Absolutely, but I don't think an hour is enough.
All right.
Like I said, I wrote an article in early September where I started to just get at a part of the Volcker myth, and it was as the basis of that article, I used the transcripts from just one Fed meeting in February of 1982. Just one Fed meeting was enough to show, I think, you that, oh, this Volcker stuff isn't what we're told it is, and that these people had no idea what they were doing in 81 and 82 or even before, and certainly they had little idea what they were doing after. They just kind of got lucky that the great inflation ended, and it had nothing to do with what they were doing or monetary policy. It was that the Eurodollar system itself transformed after taking a break of getting too far and getting extended too far, Latin debt crisis, taking losses and things like that, and it were reformed on the other side. It wasn't strictly focused in the same way it had been before. So they took credit yet again for what the Eurodollar system did. And the reason they had to was because they couldn't understand the Eurodollar system itself.
I can't wait to do the multi-part, multi-week Volcker Myth special. It'll be great. It'll be a whole series. All right, Jeff, that's it for me. And I will talk to you again next week.
Yeah, unfortunately, we're stuck with the stag, but don't look ahead to the inflation, because the only inflation isn't the inflation. So is there a stag deflation? Well, there's no reason to say stag deflation, because stagnation is the deflation. So
Stagnation.
Even this article, to me, it doesn't really make sense, because they're basically saying, yes, it's deflation, because we expect the economy to be stagnating.
Here's a quote. Just to underline their point, the central bankers will be able to manage the inflation should it ever show up. Last month, Jerome Powell, the Fed's current chairman, declared that if, quote, sustained higher inflation were to become a serious concern, we would certainly respond and use our tools to assure that inflation runs at levels that are consistent with our longer goal of 2%. That's their proof, because Jerome Powell said
so,
he
right.
would take care of it, GD. it.
And again, I keep saying,
Case closed.
why doesn't anybody ask Powell if he has all of these really good tools? Why did they go at one point almost 5 straight years of missing their inflation target and missing badly through most of that 5-year period? If they have all these powerful tools, then they should be able to have done that. But yet nobody ever asked the guy, hey, by the way, what are those tools that you're supposed to be able to use? It's just, we're just supposed to take their word for it because of the Volcker myth. And the Volcker myth was essentially reinventing history.
Thank you, Jeff. I'll talk to you next week.
All right, take care, Emil.